So financial accounting, chapter 1 to 5 we have covered so far. Let's move towards chapter 6. And chapter 6 is about inventory. What is inventory?
Recording,
Inventory.
uh, recording of the goods when you purchase from the supplier.
Stock.
Stock. Yeah. Stock in
The goods that company sold to the customer is called inventory or stock. The goods that company sold to the customer is called
inventory of
inventory or stock. There are two types of inventory, opening inventory and closing inventory. Opening inventory and
clothing.
closing inventory. What could be the difference between opening inventory and closing inventory? What is the difference between opening inventory and closing inventory?
When stock is at the
The stock coming from previous year will be called opening inventory. And the stock at the end of the year will be called closing inventory. And we will record closing inventory as a current asset in balance sheet. We record closing inventory as current asset in balance sheet. But opening inventory we use while calculating cost of sales. How we calculate cost of sales? How we calculate cost of sales? Opening inventory plus inventory purchased during the year mean purchases minus closing inventory. Through this formula, we can calculate cost of sales. So where opening inventory recorded in profit and loss account under cost of sale, and where closing inventory we record as current asset in balance sheet as well as we deduct it from cost of sale. How we can value inventory? Suppose we manufacture shirts and sell. We are having garments business and we are having 100 shirts. Quantity of shirts is 100. The cost of one shirt is say 300 and the selling price of one shirt say 500 or 300 or 250. First assume the selling price is 500, cost of the shirt is 300. The closing inventory figure, how we can calculate, we should calculate lower of cost and selling price. So what could be the figure of closing inventory? If we are having 100 shirts, cost of one shirt is 300, its selling price is 500, and we should record inventory lower of cost or selling price. So what is the closing inventory figure?
500,
What is the lower amount, 300 or 500?
300.
300. So closing inventory will be 100 units into 300 is equal to 30,000. But suppose selling price is 300, cost is 300 as well. What's the lower? Both are same. The closing inventory will be 100 into 300 is equal to 30,000. But if suppose cost is 300 but selling price is 250, what is lower?
250.
250. The closing inventory figure will be 100 into
250.
250 mean 25,000. In how we can calculate closing inventory. Closing inventory should be calculated using lower of cost or selling price. Instead of selling price, they used a term NRV. What is NRV? Selling price. Is that fine?
What's the full form of NRV?
NRV, net realizable value. We're gonna discuss it in detail later on. I'm just
Overview.
overviewing this topic. In how closing inventory value can be calculated, the number of units available at year end. So lower of cost and RV, what is value lower? We will multiply with the number of units and we can calculate closing inventory figure. So let's discuss what is this inventory chapter. So according to IAS 2, there is a accounting standard on inventory, that is IAS 2 inventories. And according to IAS 2, inventory should be valued lower of cost and NRV. NRV stands for net realizable value. Net realizable value. How we can calculate net realizable value? Selling price less cost to sell. Selling price less cost to sell. We can calculate NRV. What's the formula to calculate NRV? Selling price less cost to sell. And we will compare NRV with cost. Whichever is lower, we should value the closing inventory units on the lower amount. An inventory could be of two types, opening and closing. Where we record the opening, where we record the closing, we have discussed. How to calculate cost of sale. How to calculate gross profit.
Gross profit.
How to calculate gross profit.
Opening stock.
Gross profit. Gross profit. Sales less cost of sale.
Sales cost of sale.
Revenue mean sales less cost of sale, mean this is figure for sale, this is figure for cost of sale. We can calculate gross profit. How to calculate cost of sale? Opening inventory plus purchases minus closing inventory. So if we deduct cost of sale from sale, we will arrive at gross profit. How to calculate cost of sale? Opening inventory plus purchases minus closing inventory. You people are not studying at home. You people are just attending the classes, not studying at home. Enough. Please try to cover previous all lectures. From before next class, please cover previous all the lectures. These things I've already explained, how to calculate cost of sale, how to calculate gross profit. If you don't know how to calculate this. This means in every lecture, I have to repeat how to calculate gross profit, how to calculate profit, what are current assets, what are non-current assets. No, otherwise we'll not finish our syllabus on time. If you are missing any class, it's your duty. You should attend that lecture through record. Please try to revise the previous lecture before coming to the next class. Because in 1 week, if you don't study at home, obviously you will forget everything that we have studied previous week. Try to realize yourself, you are studying ACC. ACC is not a piece of cake that you can easily pass any paper. It's not that much easy. Otherwise, you will be wasting money, attempting the exam again and again, again and again. You have to study on regular basis. You have to revise previous topics before coming to the next class. So what we are discussing, inventories of two types, closing inventory or opening inventory. How to value closing inventory, lower of cost and NRV. Okay, see this illustration 1. At the beginning of the financial year, a business has 1,500 of inventory left over from the preceding accounting period. What is this? at the beginning of the financial year. This is called opening inventory. Okay. During the year, it purchases additional goods of 21,000. This is purchases and make a sales total of 250,000. 25,000 is a sale. At the end of the year, 3,000 goods left that have not been sold. So this is closing inventory. Can you calculate gross profit for me, please? Quick, please calculate gross profit. And from next class, I need calculator in your hand. Without calculator, please don't think to come to accounting class. You should have calculator, not using mobile as calculator. Or you can come to accounting class without calculator. It's a crime. Calculate gross profit for me. Come on. It's not that much difficult. What is sales? Sale is 25,000. Cost of sale. What is opening inventory? Opening inventory is what? 1,500. What is purchases? Purchases is 21,000. What is closing inventory? It's 3,000. So what is cost of sale? 1,500 plus 21, 22, 500 minus 3,000, 19,000. 500 is cost of sale. So what is gross profit? 5,500. 5,500 is the gross profit figure. Okay. So they have calculated sales less cost of sale, opening inventory, purchases minus closing inventory is equal to 5,500 gross profit. Test your understanding one. Can you calculate gross profit for test your understanding one? Yeah. 60. So what's the sales figure in this question? On 1st January, Tao opening inventory was 9,500 of 30 washing machines. They purchased for 150,000. At 31st December, closing inventory 7,500 and they sold for 2,150. So sale figure is 215,000. So cost of sale, opening inventory is what? 9,500 and they purchases what? 1,50,000 and the closing inventory will be 7,500. So cost of sale is 1,52,000. 1,52,000. By deducting this, we will arrive at gross profit. How much is the gross? 63,000. Okay. What is the accounting entry for inventory? Accounting entry for inventory. For closing inventory, the accounting entry is inventory debit, inventory credit. mean inventory debit, inventory asset debit that will be recorded under current assets in balance sheet. And closing inventory credit means we will deduct this from cost of sale in profit and loss account. So credit will be deducted from profit and loss account in cost of sale, and the debit will be recorded as asset in the balance sheet. What is the accounting entry for opening inventory? Debit opening inventory that will be charged to profit and loss account in which we will add purchases. And credit inventory asset that is coming from previous year. So previous year inventory we will remove, we will charge to cost of sale, and current year closing inventory we will record as asset. Okay, don't need to cover these ledgers. Test your understanding too. Even this is also relating to maintaining ledger. Ignore this. Yes, test your understanding 3. Means business described in TYU2 now continue its second week. Its transactions were as follows. Sales for cash is 1000, purchases for cash is 1100. The goods left in inventory at the end of this second week originally cost $500. This is also relating to ledger. Ignore this. Now read this. What is inventory mean? What we need to include in inventory? So inventory consists of goods purchased for resale is a part of inventory. Consumable stores such as oils is a part of inventory. Raw material, like to make shirts, we need to buy the cloth, we need to buy the buttons, we need to buy the thread for stitching. That will be called raw material. Finished goods, partially finished goods. Partially finished goods is also called work in progress. Mean incomplete shirts, shirts without button, shirts without collar, mean that need to be complete, mean there is some work left to complete it. So that will be called work in process. And finished goods mean the complete shirts. Pack. Shirts without packing, shirts without button, shirts without collar, that will be called work in process. And the cloth is called raw material. This means mainly there are 3 types of inventory: raw material, work in process, work in process or work in progress, and finished goods. So all we need to include in inventory. And goods purchased for resale that we sell as it is to the customer will be part of inventory. Any consumable stores, consumable items for the business like oils, that will also be a part of inventory. The inventory should be recorded lower of cost and NRV. NRV stands for net realizable value. What should be included in the cost? All the expenditure incurred in bringing the product or service to its present location and condition. Mean all the expenditure incurred to put the inventory into its present location for sale will be called cost. Mean raw material. In working process, what is involved other than raw material? Labor expenses like electricity expense, building rent, that is also included in working process and finished goods except raw materials. So that will be part of inventory cost. So this include cost of purchase material, Import duties, if you have bought the material from outside the country and you have paid import duties, that will also be part of inventory cost. Freight, freight mean you have paid any fare for the lorry, for the truck, for transportation of raw material from supplier to your delivery cost. Cost of conversion means that have converted the raw material into finished goods. What have converted the raw material into finished goods? Labor and overheads. Overheads mean other expenses like expense of usage of machinery, expense of building rent, electricity you use, gas you used. So that is conversion cost. So purchase cost plus import duties, freight, and conversion cost. Conversion cost includes direct cost, mean direct labor and production overheads. Production overheads mean expenses. Overheads mean expenses that are used in the production, like electricity, like rent of the building. So cost include raw material cost, including import duties, freight, and cost of conversion. The cost include raw material cost and cost of conversion. What is cost of conversion? Labor plus overheads. Overheads mean expenses. What kind of expenses? Production expenses. What is NRV? NRV stands for net realizable value. How to calculate? Selling price less cost to sell. What is NRV? Revenue expected to be earned in the future when the goods are sold less any cost to sell. I mean, if to sell the inventory, you have to pay any commission to any agent. So you need to deduct that commission from selling price, then you will arrive at NRV. Because sometimes some type of products you cannot sell directly. You have to sell through any agent, especially the food items, the crops that you have produced, you cannot sell directly to the customer. You should sell through any agent, and agent will charge a commission. So you need to deduct that commission from selling price to arrive at NRV. And whatever is the lower amount, either cost or NRV, you have to value your inventory on lower amount. And for normal goods, cost is always lower than NRV because NRV include selling price. Selling price include profit part as well. Like you have produced a good in 100. Will you sell it in 100? No, you will sell it for 120. Suppose out of this 120, you have to pay 5 commission. So what is NRV? 115. So cost is lower. So for normal goods, you normally record closing inventory on cost. But there are some items that are damaged, obsolete, or out of fashion. Can you sell them on 120? No. No. Might be you can sell them on 50. Discount. For obsolete, damaged items, out of fashion items, and RV is lower than cost. For normal items, cost is lower than NRV. But for obsolete, damaged units, NRV is lower than cost. So we should record inventory, closing inventory on NRV basis, especially for obsolete, damaged units. Is it fine? So what is mean by cost? Cost include all cost of purchase, cost of conversion, mean labor plus overheads, and other cost incurred in bringing the inventories to their present location and condition. And this include cost of purchase like material cost, import duties, freight, and cost of conversion include direct cost and production overheads, depreciation of productive machinery. If you are using any machinery in production, its depreciation is a part of inventory cost, cost of sale. Building that you are using In production, its depreciation is also included in cost of production. And according to IAS 2 inventories, the following cost should be excluded from the cost of inventory, mean which cost should not be part of inventory cost. Very important. Selling cost should not be part of inventory cost. Selling cost like advertisement. Storage cost, where you have stored your inventory, that should not be part of inventory cost. Cost of abnormal wastages. If during production there is some wastage of raw material, that should not be part of inventory cost. Administrative overheads, admin expenses, that should be part of operating expenses rather than inventory cost. Note, however, that storage cost would be classified as part of cost of inventory if they were incurred as necessary part of production or manufacturing process. During production, if you need to hold raw material into storage, so that storage you can include into inventory cost. Without storing, you cannot produce goods. But after production, if you are holding finished goods inventory, so that storage cost will not be part of inventory cost. That will be other expense. Should be charged to profit and loss account rather than to cost of sale or production cost. As an example of this could be product stored while it matures or ripens before it is suitable for next stage of the production process. Like sometime after producing half part of the inventory, you have to keep it for some time, for some days, like to maintain their shape, and then you will start next process. So that storage will be called stock of production. But after completing the inventory, if you are storing before receiving order from the customer, that storage cost will not be part of inventory cost. So upon reaching an appropriate level of maturity or ripeness, the product would proceed to the next stage of production or no to finishing or packing and ready for sale. So which cost should not be part of inventory cost? Selling cost, storage cost, cost of normal wastages, and admin overheads. What is the net realizable value? Selling price less cost to sell, or you can say fair value less cost to sell. Fair value mean market value. What is market value? The value on which you can sell your product in the market, that is selling price. Net realizable value is the net amount that would be realized after incurring any further cost required to make the sale. What you will receive by selling the inventory in the market. Obviously, if you are paying any commission, so you have to deduct from that. What you will receive in your pocket after selling the product in the market, that's called NRV. In fact, it is the fair value of the item in market value less any further cost that may be incurred in order to sell the item. And this may include further work and cost required in order to make item of work in progress into finished goods before they could be sold. If there is any further work required to sell the inventory in the market, so that will be cost to sell. And IS2 is applied when item of inventory are old or obsolete, out of fashion, obsolete, damaged. They are likely to be valued at NRV than cost because their NRV is normally lower than cost. There are three components of inventory: raw material, work in process, finished goods. If raw material is 200, work in process inventory is 600, and finished completed shares are of a 350 value. What is the total value of closing inventory? 1150. If in a business store, there is raw material, there is some fabric. Okay. There is a work in progress, incomplete shares, and there are complete shares of 350 as well. So what is the closing inventory? 1150. Text your understanding one. Coal company's business sells three products X, Y, Z. The following information was available at the year end. The cost of X is 7, while fair value less further cost to sell mean NRV is 10, and business is having 100 units of X. For product Y, the cost is 10, NRV is 8, and business is having 200 units of product Y. And for product Z, business is having a cost 19, NRV 15, and business is having 300 units of product Z. Can you calculate closing value for all these three products X, Y, Z?
Altogether.
Altogether. I mean, there are three types of products. Their cost and RV are this, and their number of units at the year end were this. Can you calculate closing inventory figure? Please try to calculate closing inventory figure. Lower of cost and RV. For product X, what is the lower value? 7. So 7 into 100, 700. For product Y, what is the lower value? 8. 8 into 200, 1600. For product Z, what is the lower value? 15. 15 into 300,
4,500.
4500. By combining all together, what is the value?
6,800.
6800. Option B. That's your understanding 5. In what circumstances might the fair value less further cost to sell of inventory be lower than its cost? In when an RV is lower than cost
If it
for old,
put
damaged,
or obligated.
obsolete,
Obsolete.
out of fashion. or out of date inventory, expired inventory. Test your understanding 6. Storm company and entity had 500 units of product X at 30th June 20x5. If it is a year end, this is closing inventory. The product had been purchased at a cost of 18 per unit, sells for 24 per unit, mean they bought these units 500 at 18. So this is 18 is cost per unit. Purchase. They can sell at 24. This is selling price. Recently, product X has started to deteriorate, but can still be sold for 24 per unit. They can sell for 24, provided that some rectification work is undertaken at a cost of 3 per unit, but you need to perform some rectification work of 3, then you can sell at 24. So what is NRV? 24 minus 3, 21. Can you calculate closing inventory?
Yeah.
What is cost?
Cost is the $18.
18. So what is NRV?
21.
24 minus 3, 21. So which is lower figure?
Cost
So into 500,
9,000.
9,000 is our closing inventory figure. Is that fine? Test your understanding 7. Please calculate closing inventory. In 2000, Hurricane and entity had 1,500 units of product Y at 30th June. So this is the units.
Yeah.
The product had been purchased at 30 cost and normally sell for 40. Recently, product Y started to deteriorate and can now be sold for 38. And rectification work is 28. So 38 minus 10 is 28. So what is lower? 28. So 1,500 into 28, what is?
14,000.
14,000? 42,000. Test your understanding 8. According to IAS 2 inventories, the items that may be included in computing the value of an inventory of finished goods manufactured by a business are clearly specified. Which one of the following list consists only of items which may be included in statement of financial position value of such inventory according to IAS 2? Mean which cost should be included in inventory? Part A, foreman wages, mean factory worker wages, yes. Carriage inward,
Yeah.
mean coming inventory inside the business, yes. Carriage outwards,
Yeah.
no, this is operating expense, selling expense. Inventory going out of the business. Carriage inward, inventory coming into the business, that will be cost of purchase. Carriage outward means selling expense, inventory going out of the business. So this is not. Number 2, raw material, yes. Carriage inward, yes. Cost of storage of finished goods, no. Part C, plant and machinery cost mean depreciation, yes. That is used during production. Carriage inward, yes. Raw material, yes. Foreman wages, yes.
Option C.
What is option D? Carriage outwards, no.
No.
There are 3 methods of calculating inventory. This is the main topic of these chapters. See here. Okay. Date, unit, price amount. Suppose on 1st January, company have purchased 200 units at the rate of 5. What is the amount? 1000. On 4th of January, they purchased a further 100 units at the rate of 6. What is the amount? 600. On 10th of January, they have purchased a further 200 units at the rate of a price, say 5.5. What is the amount? 1100. On 15th of January, they further purchased 300 units at the price of 6. What is the amount?
1800.
18,000. 1800. On 20th of January, they purchased a further 200 units at the price of 5. What is the amount? 1000. Now suppose company sold 400 units on 12th of January. Where is 12th of January? Here. How much unit they have sold?
400.
400 units. What is the value of closing inventory? This means if they sold 400, these 200 all gone.
200 or more.
This 100 also gone. Out of these 200, how much left?
100.
100. So what is the closing inventory? 100 into 5.5 will be
550.
550, plus these are still there 1800,
Yeah.
plus these are still there 1000. So closing inventory figure will be 2800 plus 550, 23. Can you understand this?
Yeah. In this problem, they gonna keep in the middle.
And what is the closing inventory?
What's the closing?
If you bought these, and you sold 400,
In the middle.
so that will be eliminated. The remaining units with their value will be closing inventory. This is called LIFO method. No, sorry, FIFO method. FIFO stands for first in, first out.
First in, first out.
If suppose if they sold 400, they are eliminating 200 these are first, and then 200 from this. That will be called last in, first out method, mean LIFO method, but this method is not a good method,
Not good.
especially for perishable products. Otherwise, the goods bought before will become obsolete, will become out of date, deteriorate. So that's why for perishable products, especially, which method is good for maintaining inventory? FIFO. Now move towards one other method called AVCO method. Average cost. AVCO stands for average cost. FIFO stands for first in, first out. LIFO stands for last in, first out. What is AVCO method? We need to calculate closing inventory figure. They bought these inventory on this date, and they sold 400 units. Yes. How we will calculate closing inventory? We will add this total and number of units. Yes. What's the total of amounts? 1000 plus 600, 1600 plus 1100, 2700 plus 1800, 4500 plus 1000, 55. What's the total of units? 345 plus 38 plus 2, 1000. Now we will calculate average price. 5500 divided by 1000, 5.5. And if we have sold 400 units, so we have sold 400 units at what price? 5.5. So what is the value of 400 units at 5.5? 2200. And if we deduct this, the closing inventory figure will be 3300. Or you can say how many units are remaining there? 600 at the rate of average price. What is average price? 5.5. So 3300 will be closing inventory, and this is called AVCO method, average cost method. In average cost method, what you need to do, you need to make a total of all the amounts. You make total of all the units and then find average price per unit. And the unit sold will be according to average price per unit, or the unit remaining you should calculate according to average price per unit. If there were total 1,000 units, how many sold? 400. How much remaining? 600.
We have to do that.
So what is the average price? 5.5. So 600 into 5.5, 3,300 will be closing inventory. Is that fine? So there are different methods of managing inventory. LIFO, FIFO, AVCO. LIFO is no more there because it's not a good method. So nowadays, nobody use LIFO. Either FIFO is used or AVCO is used. Okay. Station 3. Invicta company has a closing inventory of 5 units at a cost of 3.50 per unit at 31st December 20x5. At 31st December 20x5, they were having 5 units at 3.50. During the first week of January 20x6, Invicta company entered into following transactions. This means you are currently in 2005 or 2006? 6.
Yeah.
This means this is opening inventory. This is opening inventory that is coming from previous year. And during year, they purchased on 2nd January 5 units at the rate of 4. 4th January, they purchased 5 units at the rate of 5. On 6th January, they purchased 5 units at the rate of 5.50. And Invicta sold 7 units of for 10 per unit on 5th of January. Can you calculate closing inventory figure using FIFO method? Can you calculate closing inventory figure using FIFO method? Yeah.
.5.
64.5. How you have calculated? They were having opening inventory at 1st of January.
Yeah.
So 1st of January, they were having 5 units at the rate of 3.5. So 17.5. On 2nd January, they bought 5 units at 4 is equal to 20. On 4th January, they bought 5 units at the rate of 5.50 is equal to what?
5.
At 5, sorry, not 5.50, at 5. So they were having 25, and on 6th January, they bought how many units? 5 units again at 5.5. So 27.5. This they were having. And they have sold 7 units using FIFO method. This means these 5 gone first.
Yeah. And the second.
And out of these 5, how much left? 3 left. So what is the closing inventory? 12
12, 25,
plus 25 plus 27.5. What is the closing inventory?
64.5.
64.5. Can you calculate GP as well? They sold 7 units for 10. So what is the sales value? What is
10.
70?
Total value 7.
So sales is 70, and cost of sale we can calculate. What is cost of sale? Opening inventory. What is opening inventory? 5 into 3.5.
17.5.
17.5. How much are the purchases during the year? These are the purchases. These are the all purchases. 17.5 plus 20, 37.5. Can you add them? 72.5 is the purchases. And what is the closing inventory? 64.5. If we deduct that, we will arrive at a cost of sale. What is the cost of sale figure? 17.5 plus
4.5, 25.5 plus 70.
Just tell me cost of sale figure. 17.5 plus 72.5. 90 minus 64.5 is
25.5.
25.5. If we deduct this, we will arrive at gross profit. What is that?
44.5.
44.5. So we have solved requirement A using FIFO method, and we have solved requirement B, mean we have calculated gross profit figure. Is that fine? So here we have used what method? FIFO only. Now we are moving towards, we need to calculate closing inventory using a periodic weighted average method, and we need to calculate gross profit as well.
So we have to do every.
See. So these were the units we opening and bought. And using AVCO, what we do, make their total. So here we are calculating what? Periodic weighted average. So there were units, how many? 20? How many units were there? 20. And what is the average cost? 72.5 divided by 20.
We have, we didn't add 17.5, it's total 90.
Is that total 90?
Yeah.
Okay. Yes, total is 90. So 90 by 20, what is that? 4.5 or 5.5? 4.5. 4.5? 90 by 20. Simple.
90 by 20, yeah.
4.5 is the average price per unit. So what is the closing inventory? How many units you are having? So you have sold 7 units out of 20. How much are there? 13 units at the rate of 4.5. What is the closing inventory figure?
58.5.
58.5 is your closing inventory. So this is requirement A that you have solved. Now moving towards requirement B, we need to calculate gross profit. So sale will be 70 as it is. Opening inventory will be 17.5. Purchases will be 72.5. So what will be the closing inventory figure? 58.5. So what will be the cost of sale and GP figure?
31.5 cost of sale.
31.5 is cost of sale and your GP will be
38.5.
38.5. So we have solved this question using a FIFO method and using periodic average cost method. Periodic average cost method. Now we are moving towards continuous average cost method. What is that? Continuous average cost method. I'm removing all this. In continuous average cost method, how we can calculate closing inventory? Let's know. Continuous average cost method. Weighted average cost method. Not average. Weighted average cost method. We need to make 3 columns. First column, second column, and third column. In first column, we will record purchase. In second column, we will record sales. And in fourth column, we will record left or net. And under all these 3 columns, we have to make further 3 sub columns. One for the price, units. One for the price and one for the amount. Unit, price, amount. Unit, price, and amount.
The last one is net.
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 Okay. Now move to this question. So in previous year, we bought 5 units at 3.50. So we'll record as purchase 5 units at 3.50. How much is the amount? 17.5. And there is no sale. So it will be 5, 3.5, 17.5. Next, we bought 5 units for 4. So if we bought 5 units for 4, so 20. So there will be no sale. What is the net? How to calculate this net? This total
Plus
this total. It will become 37.5. This total and this total, how 10. So we need to calculate average price. It will be 3.75. Is that fine? Next, what you did? Bought or sold? Bought 5 units at the rate of 5. 25, there is no sale. Now this total 37.5 plus 25, how much is that? 62.5.
Yeah.
And 10 plus 5, 15.
15.
What is the average price?
Point three,
4.375. Next, what you did?
okay.
Now purchase 5 unit on 6.
But we have sell on fifth.
Hmm.
Sale
So
on
we have sold on 5th. Yes, yes, yes. Now we need to record sales. How much unit you have sold? 7. At what price you have sold? At what price you have sold?
okay.
10.
10 per unit.
But that is a selling price. So you have sold at 4.375, the average value. In the out of this, 7 is going. So how much left? 8 left at the rate of 4.375. What is that? 35. Next, what you did? You have purchased how many units? 5 at the rate of 5.50. What is that? 27.5.
Yeah.
There is no sale. So 8 plus a 5, you are having 13 units. 35 plus 27.5, you are having a value of what? 62.5, mean adding this and this. So what is the average price per unit you are having?
Average price 4.9375.
4.934. But you need closing inventory. This is the value of closing inventory. This is the value of closing inventory. In there were 5 units opening, 15 units you bought during the year. There were 20. Out of 20, how much sold? 7. So remaining 13 units left. What is their value? Their value is 62.5. This is your closing inventory. 62.5. And you can calculate GB. Sale is a 70. Cost of sale, you are having opening inventory of what? 17.5. Purchases you have made during the year of how much? How much purchases you have made? That we have calculated previously of 72.5.
Yeah, 72.5.
And closing inventory is 62.5. So what is cost of sale?
27.
So by deducting this, you will arrive at gross profit of what amount?
42.5.
42 point. So this is continuous weighted average method in which you have to make 3 columns, one for purchases, one for sales, and one for net. And in a net, the last value will be your closing inventory. Is that fine? I think there is some mistake in your calculation.
Sir.
We are having opening balance of this. There were some mistakes in your calculation.
Errors.
This is GP. This is periodic. This is ABCO. Opening were this, then you purchased 5. There were 37.5. Then you purchased 5, 62.5 at the rate of 4.17. This value, can you calculate? Is that 4.375? 62.5 divided by 15. 62.5 divided by 15 is 4.17 rather than 4.375. That's why this value is coming wrong. So you need to calculate this again, 4.17. So there is one mistake, but the process is same. That's why the GP figure is different in the answer. Okay, let's move forward. Test your understanding 9. What we need to do. A business commenced trading on 1st January and purchases were made as follows. January, February, March, April, May, June, these are the purchases at these price values. In June, 1420 articles were sold for 7,000. What is the cost of closing inventory and gross profit for the period using FIFO method? How much you have sold? 1420. So this means these 380 out of 1420, these 380 gone first, and then 400 gone, and then 350 complete gone. How much altogether? 750 plus 380. So this gone, this gone, this gone. How much remaining? 1130, I mean 1420 minus 1130, how much is remaining? That we need to deduct from the April 420. So 290 will be gone from this. So how much will be remaining? 420 minus 290. 130. So 130 will be there. So what is the closing inventory? 130 into 2.75. 2.75, 130 into 2.75. 357.5. 380. 357.5. 357.5, 1290 will be there. 1430 will be there. So you can calculate closing inventory. Ah. 3077.5. 3077.5. 3000 or 3077.5. So 3077.5 C option. Now calculate GP whether it is 3567. So sale is a 7,000. Cost of sale, what are the purchases figure? Purchases figure is a 6 of opening inventory. What is the opening inventory? Opening inventory. There is no opening inventory. Yeah. So there are purchases of 6510 and there is closing inventory of 3077.5. So what is cost of sale figure? 6510 minus 3077.5. 34. 32.5. If we deduct from 7,000, whether it will become 3567. Yes, 3567.5 or 66.5. Okay. Next, moving towards require test to understanding 10. On 1st July 20x6, an entity Pinto Company had 10 items of inventory at a unit cost of 850 opening inventory. Pinto company then made the following purchases so these are the purchases on 14 October, 22nd November, 13 December. And they sold on 23rd of August. Mr. Please. So 10 into 8.5, we are having 85 opening inventory. We bought 15 units at the rate of 9. How much is that? 140, 135. We bought 25 units at the rate of 9.20. How much is that? 230. We bought 20 units at the rate of 9.50. How much is that? 190. 190. It's already there. And then we sold 7 units. We sold 10 units. We sold 14 units. So what we need to cap the price and we need to make those sales and then we get so we have divided by 9.14. Six. One 9.14. This means we are going to sell how many units? 50. So out of this 70, 50 gone. How much remaining? 20 at the rate of what? 9.14. So what is the closing inventory figure? 182.8. 182.8. This is closing inventory using periodic method. Now we should move towards continuous method. For that, we need to make 3 columns. Okay. And that's all. No, inventory yeah. Sorry. So we need to make three columns. One big column, sale, one one over days for sale and one column for net. Sales, sale. Okay, we are having opening of returns at 8.50 85. So the net cost and 8.5 and 8. Then what comes first, purchase or sale? Sale on 23rd of August. How much sale? 7 units. So we sold 7 units. At what price? At price of 12 or at price of 8.5? 8.5, 8.5. So we have sold using Avco. So Avco is 8.5. So we are having 3 units left. At 8.5, what is the value? 25.5. 25.5. This we are having. And then we have a purchased. 15 units. On 14th October, we have purchased 15 units at the rate of what? 9. So value is 135. So there is no sale. So 3 plus 15 is 18 and 25.5 plus 135. 160.5. 160.5 divided by 18. What is the average price? 8.92. 8.92. And after that, on 22nd November, we purchased, but on 20th October, we sold something. Yeah. There is a sale of 10 units. 10 units. At what price? 8.92. So out of 18, we are having 8 left. At 8.92, what is the net? 71.36. And then on after 20th October, on 22nd November, we purchased 25 units. At 9.20 to 30. So no sale. 8 plus 25 is a 33. 230 plus 71.36. 301.36. 301.36. What is the average price? 9.13. And after this purchase of 25 units on 22nd November, we sold on 30th November. How many units? 18 or 15? 15 we have sold. at the rate of what? 9.13. So this we have done, this we have done, this we are coming, going, this have done, this have done. So 9.13, so from 33, 15 sold, so 18 left. At the rate of 9.13, how much? How much?
18 into
9.13.
164.34.
164.34. So next, on 13 December, we purchased 20 units at 9.50. So 20 units purchased at 9.50, value is 190. So what is 18 plus 20 is 38, and 190 plus 164. What is the value per unit? Divided by 38.
9.32.
So then we sold how much? 18 units at 9.32. Out of 38, 18 sold, 20 left at 9.32. What's the value? 186.4. So this is the closing inventory figure. Is that fine? This chapter has completed now. There is nothing left in this chapter. Let's take a break. After break, we will discuss next chapter. Chapter 7. That is about non-current assets. Chapter 7 is about non-current assets. What is the difference between current assets and non-current assets? What is the difference between current asset and non-current assets?
Current assets are assets which we have right now. The non-current assets, maybe they are not permanent, non-current assets.
Current assets, the assets that provide us benefit in less than 12 months will be called current assets. And non-current assets that provide us benefit in more than 1 year, more than 12 months. The permanent assets are non-current assets. The temporary that will be changing during the year that are called current assets.
Correct.
What are current assets? Inventory. In closing inventory is a current assets. Receivable is a current assets. Prepayments is a current assets. Cash in hand or cash at bank is a current assets. In this chapter, we are going to discuss non-current assets. There are two types of non-current assets. Tangible non-current assets and intangible non-current assets. Tangible, the assets that we can see as well as touch. What could be those? Land and building,
Machinery,
plant and machinery, furniture and fixtures,
vehicles,
motor vehicles.
motorbikes.
So these are called non-current assets because these assets will stay more than 12 months and will provide us benefit to the business in more than 12 months. What are intangible assets that we cannot see or touch?
Patents, time,
Patents,
will,
copyrights,
copyrights, will,
goodwill.
goodwill,
What is goodwill?
appear,
No. Suppose if there is a business whose value of asset is 100,000, but you are going to buy that business in 120,000. 20,000 you are paying more for his
reputation,
that is called goodwill. In amount over the asset due to repute of the business will be called goodwill. In our syllabus of financial accounting, we need to discuss tangible non-current assets. The discussion of these is not in our syllabus. Intangible assets you will study in financial accounting paper, in financial reporting paper. Currently, we are studying financial accounting. There are two more accounting paper, financial reporting and strategic business reporting. So about intangibles, you will study in financial reporting. So what are the non-current assets? Land and building, plant and machinery, furniture and fixture, motor vehicles. If suppose we have bought a plant and machinery, its purchase price mean cost is part of non-current assets. If we have paid any freight, that will be also part of asset cost. If we have paid any import duty, that will also be part of asset cost. If to install that asset, we need to bear some installation cost that will be part of asset value. If we paid any legal fee, like to acquire any land and building, mean to buy land, we have paid any registry fee, legal fee, that will also be part of asset value. Is that fine? Sometimes business buy asset and sometimes they construct asset. If they buy, all the buying cost will be part of asset value. But if we are constructing an asset like building, we are constructing, and this building construction requires 3 years, 3 years time. So what cost we need to record in asset value? There are two types of expenditure. One is called revenue expenditure, and other is called capital expenditure. Mean expenses, mean expenditure are of two types: revenue expenditure and capital expenditure. Capital expenditure are those expenditure that provide us benefit in more than 12 months. So we should record them asset in the balance sheet. Revenue expenditure are those expenditure that provide us benefit in less than 12 months. So we should expense out them. We should expense out these revenue expenditure. Where we should record expenses? Profit and loss. So capital expenditure should be capitalized into asset value. Revenue expenditure should be expense out. If suppose we are constructing an asset. Asset construction started on 1st of March 2023. And its construction will complete on 30th of September 2024. All the costs incurred between start date and completion date. This is completion date of the asset. This is start date of the asset. So all the expenditure incurred between start date and completion date should be capitalized, and expenditure incurred after completion date should be expense out, mean should be treated as revenue expenditure. And if we are constructing an asset, so all the cost, all the expenditure incurred from start date till completion date of the asset should be capitalized, and expenditure incurred after completion date should be expense out because they are revenue nature. Is it fine? Okay, let's discuss few things. So non-current assets, either we purchase, so measure at cost and record purchases, capitalize, use within business, and we are using asset during the business. If we are using the asset in the business, we need to record depreciation of the asset as well. We need to record depreciation. Suppose we bought an asset, in asset cost is 100,000. While buying asset, we estimate its life. Like this asset will provide benefit to our business for 10 years. This means we need to depreciate this asset for 10 years. If asset cost is 100,000, its life is 10. So what we will do? Cost divided by life, we can calculate depreciation. So what is cost? 100,000. What is the life? 10 years. So per year depreciation will be 10,000 depreciation. We need to record this as expense in profit and loss account. Why? Because we are using this asset, and this asset is providing a benefit mean helping the business to generate its sales, its revenue. So we should charge asset cost to the revenue. So what revenue? How many years the business can generate revenue from this asset usage? If 10 years, we will depreciate it over 10 years, mean every year we will charge 10,000 to revenue as expense. If this will provide benefit for 5 years, then we will calculate depreciation 100,000 divided by 5, 20,000 we will charge depreciation every year. So as we are using asset, we need to depreciate it. And there are two methods of depreciation. One is called a straight line method and other is called reducing balance method. What are those methods? We will discuss later on. Yes. What are non-current assets? Non-current assets are distinguished from current assets because they are long-term in nature, mean will stay more than 1 year, are not normally acquired for resale. The asset we acquired for resale, like inventory, is called current assets. The asset we acquired not for resale, need to keep in the business, to use in the business, to get benefit of this asset in the business, that will be called non-current assets. Could be tangible or intangible, are used to generate income directly or indirectly for the business, mean they will help the business to generate revenue, income. Are not normally liquid asset, mean cannot be converted into cash form easily. Inventory, receivables, cash at bank, we can convert into cash easily, but they cannot be quickly converted into cash, mean they are not liquid. Liquid mean that can be converted into cash easily. And there are different expenditures. Asset expenditure mean what expenditure should be capitalized. Mean what are the examples of capital expenditure that should be part of asset cost. So we are discussing about capital expenditure. Expenditure on the acquisition of non-current assets mean its purchase cost, not for resale. Expenditure on existing non-current assets aimed at increasing their earning capacity. Mean if any expenditure incurred on the asset that will increase its earning capacity, we will record it as capital expenditure. Like we are having a building. In our building, we are having 3 rooms. If any of the door got damaged, we are going to repair that door. Is that door repair cost we should capitalize or expense out? Expense out, because this door repair cost will not enhance productive capacity, mean income of the revenue. If we are paying some money for whitewash, is that whitewash will increase income of that building? No, this will be expense out. But if suppose we are building another room in the building, this other room cost will enhance income of the asset because we can rent out 4 room now. So this should be capitalized. So what that is saying, expenditure on existing building, existing asset aimed at increasing their earning capacity. Mean through that expenditure, if asset earning capacity can be increased, so that should be capitalized. If earning capacity cannot be increased, earning capacity will remain same due to that expenditure. So that expenditure should be treated as revenue expenditure. What could be the other capital? Assist expenditure in long term in nature, as the business intend to receive the benefit of expenditure over a long period of time. In any expenditure that will provide us benefit in more than 1 year will be called expenditure. What are the revenue expenditure? That should be expense out. Means should not be capitalized as adjustment. Expenditure on current assets. They are not non-current assets. Expenditure relating to running the business, such as admin cost. Expenditure on maintaining the earning capacity of non-current assets, for example, repair and renewals, mean their earning capacity will remain maintained, not increasing. If increasing, capitalize. If not increasing earning capacity of asset, that expenditure will be treated as revenue. Repair, whitewash, etc. Expenses, expenditures relating to the current accounting period and is used to generate revenue in the business, mean that expenditure will provide benefit within a year, will be treated as revenue expenditure. What is the current asset register? Every company have to maintain a register for non-current assets that will be called non-current asset register. In that register, business have to record all the detail of the asset. In that register, they have to record cost of the asset, date of purchase, when the asset was bought, asset description, mean where it is going to be used in the business. Either it is a plant and machinery, either a building for the production site or the building for the sale location. Serial reference number should be there. If you are having 10 different vehicles, so their number should be mentioned. Location of asset mean where that asset is kept, either in warehouse, either in production site, either in sale outlet. Depreciation method, either straight line or reducing balance method. Expected useful life, how much is the life of the asset, 10 years, 5 years, 20 years, if land, more than 50 years. Carrying amount, net book value. What is net book value? Cost less accumulated depreciation is called carrying amount, called carrying value or net book value. How to calculate carrying value or net book value? Cost less accumulated depreciation. And we state non-current assets in balance sheet at net book value. Cost less accumulated depreciation. Asset expenditure, what should be included in asset cost? Purchase price, delivery cost, legal fee, like registration of land, registration of motor vehicles, subsequent expenditure which enhance the asset earning capacity. If not enhancing earning capacity, should not be capitalized. And trials and test means some asset without cannot use that. So their testing cost will also be part of asset cost, means should be capitalized. What expenditure should be treated as revenue? Means should not be part of asset cost. Repairs, renewals, repainting, admin expenses, general overheads, mean electricity, gas, telephone bill, training cost, and wastage of raw material. What is the accounting entry if you have purchased the asset? Non-current asset debit,
Bank.
credit if you have paid cash or check, bank. If you have bought on credit, payable will be credit. Subsequent expenditure mean if you have bought any asset and after buying, there could be some other expenditure that would be called a subsequent expenditure, out of which should be capitalized, which should be expense out. If subsequent expenditure enhancing earning capacity, they should be capitalized. If not enhancing earning capacity, should be treated as expense out. After buying land and building, you have spent some money for repairs, for paint, or you have built a new room. So new room will enhance productive capacity, that should be capitalized. Paint repair will not enhance, mean increase earning capacity, they will just maintain earning capacity.
Sir,
Because if we don't paint, if we don't repair, might be earning capacity will reduce. If we paint or repair, earning capacity will be maintained. So that will be revenue expenditure.
renovation also is expense out, right?
Renovation expense out because they will maintain earning. Without renovation, earning will reduce. Why we are renovating? So that earning capacity should be maintained. If renovation, like building a new room, obviously this will increase income, rental income, because now we can rent further room. So this will be capitalized. So subsequent cost on non-current assets can only be recorded as part of the cost mean capitalized if it enhance the benefit of the asset mean earning of the asset, i.e. increase the revenue capable of being generated by the asset. An example, subsequent expenditure which meets this criteria and so can be capitalized is an extension of shop building which provides extra selling space, building a new room. Test your understanding one. You need to calculate what amount should be capitalized for land and building and motor vehicle. There are two assets. You need to see what amount should be capitalized as land and building and motor vehicle. So Billy started a business providing a limousine taxi service on 1st January 20x5. In the year to 31st December, Billy incurred the following cost. Office premises, mean land and building, 250. Legal fee should be capitalized.
Yeah.
Cost of material and labor to paint office in Billy Bilbo's favorite color. This should be expense or should not be capitalized. Mercedes E series estate car. So this is motor vehicle. Capitalized.
Yeah.
Number plate for car. Obviously legal fee. Without number plate, you cannot run the car. Delivery charges for car. Yes. Road license fee for car. Driving license fee.
No.
No. This is personal. This is personal. Driver's wages for first year of operation. No. These are expense.
Expense out.
These are expense out. And a blank taxi receipt mean in business somebody have used a taxi, that is a expense rather than motor vehicle asset. So what is the cost of land and building? 250 plus 10, 260. What is the option for 260? C, what is motor vehicle? Is that 116,390?
Yeah.
Add these three.
Yeah.
Yes. Now we are moving towards depreciation. There is a accounting standard on asset, non-current assets, that is IAS 16. And the name of that asset is PPE, property, plant, and equipment. PPE is accounting standard for tangible non-current assets, not intangible, tangible non-current assets. Property mean land, plant, and building mean fixed asset, non-current assets. And according to IAS 16, all non-current assets should be depreciated over their useful life. Mean how many years company is using that asset, mean getting benefit of that asset should be depreciated over those life. If company is using 10 years, it should be depreciated over 10 years. If company is using for 8 years, it should be depreciated for 8 years. What is depreciation? Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. How to calculate depreciation using straight line method. Using straight line method. Straight line method mean depreciation same for every year. Straight line mean same depreciation every year. In the same amount will be recorded as depreciation expense every year. How we can calculate depreciation using this method? Depreciation is equal to cost over useful life. You have bought asset in 100,000. Its useful life is 500,000 over 520,000 will be depreciation every year. But the main formula is cost minus residual value over useful life. RV stands for
Residual value.
residual value. What is that residual value? Also called scrap value, also called salvage value. What is that? If suppose company management has estimated, like after using this asset for 10 years, we have bought in 100,000.
Yeah.
After using for 10 years, we can sell this asset in 15,000. So that 15,000 is called scrap value, residual value, or salvage value. So asset cost is 100,000. And they have estimated we can sell this asset for 10,000.
Okay.
And its life they have estimated as 10 years. So what is depreciation? 90,000 over 10 years. 9,000 each year they need to depreciate. Straight line. This is called straight line method. How to calculate depreciation? Cost less residual value over useful life. This cost less residual value will be called depreciable amount. So the main formula using straight line method is depreciation is equal to depreciable amount over useful life. What is depreciable amount? Cost less residual value. If there is no residual value, then cost over useful life. Simple. So what is depreciation? The systematic allocation mean every year we need to allocate some cost of the depreciable amount of an asset over its useful life. In simple terms, depreciation spread the cost of asset over the period in which it will be used. Mean we are using that asset for 10 years, so we are charging asset cost to revenue for 10 years. Depreciation matches the cost of using a non-current assets to the revenue generated by the asset over its useful life. Mean we are charging the cost of asset usage to the revenue because through this asset usage, company is generating revenue. Without asset usage, company is not able to generate revenue. So that's why we are charging asset cost to the revenue every year. Depreciation must also be matched to the pattern of use of asset. There is another method of depreciation that is called reducing balance method. Are also called written down value method. RDV method. In this method, we charge a percentage to the cost. Suppose asset cost is 100,000 and depreciation rate is 25%. How we calculate depreciation? So cost is 100,000. For year one, we will record depreciation. How 25% is the rate. So 100,000 into 25%. So 25,000 will be depreciation for the first year. And then we will calculate its carrying value, also called net book value. That is 75,000. For year two, we will charge depreciation 25% rate on this carrying value. What is that? 25% of 75,000. Calculate, please. 18, 7, 25? 75,000 into 0.25. 18,750 is the depreciation for year 2. What is the net book value after year 2?
56,000.
56,250. And for year 3, we will charge depreciation on 56,250, mean the value, carrying value of last year into 25%. What is that? 14,6, 14,
062.
14,062.
0.5.
0.5 is fine. What is the net book value?
Value. 42,188.
42188. And next for year 4, we will charge depreciation on 42188 into 25%, and we will calculate net book value and so on.
Yeah.
Have you seen in straight line method, we are charging the same depreciation every year. While in a reducing balance method, the depreciation every year is reducing. That's why it is called reducing balance method. Whether we should charge straight line method for depreciation or reducing balance method, it depends upon asset usage. If any asset is providing you same benefit every year, like land and building will provide you same benefit every year, so you should calculate depreciation based on straight line method. If any asset benefit is reducing over the years, like plant and machinery, as they becoming older, they will provide less benefit. So we should depreciate them using reducing balance method. Now we can understand this last point. Depreciation must also be matched to the pattern of use of an asset. Mean how much benefit they are providing each year. Same, straight line, different, then reducing. According to IAS 16, the estimated useful life of item of property, plant and equipment mean non-current assets must be regularly reviewed and may be changed if the method no longer matches the usage of the asset. If suppose you bought an asset with 100,000 and you estimated its useful life is 10 years. But after 3-year usage, you realize this asset become too old. It will not run for 10 years. After 8 years, it will be finished. This means after 3 years, you have realized. Then you need to calculate depreciation on the new life. After 3 years, what is the value of the asset? If you have a cost of 100,000, for 3 years, you depreciated 10,000 each year.
Yeah.
Mean 30,000 you have already depreciated. So what is the carrying value now? 70,000. Now you have realized its life is 8 years. Now you will calculate depreciation based on 8 years, and this should be depreciation from year 4 on. Mean if you have realized the estimated useful life is different, then you need to calculate depreciation using the new life. Okay, let's move towards depreciation questions. There are two methods, straight line method. Depreciation charge is the same each year, and so assume that the benefit is consumed evenly. Useful for asset which provides equal benefit each year, not machinery. You can say land. And reducing balance method, a reducing amount of depreciation is charged each year, and so assume that more benefit is consumed in initial years, and less benefit in subsequent years. Useful for asset which provides more benefit in earlier years, for example, cars, IT equipment, and machinery. And using straight line method, what is the formula? Cost less residual value over useful life. And using reducing balance method, X mean net book value into, oh sorry, rate into net book value or carrying value. Okay, there is one more point. If we bought an asset during the year, if we bought an asset during the year, our year start from 1st January 2024, it ends on 1st January to 31st December 2024. At what date we calculate the depreciation? At year end date. If we bought asset during the year, suppose we bought asset on 1st of April 2024. The complete year depreciation is 10,000. Whether we should charge this 10,000 complete in this year? No, we use the asset for how many months? 9 months. This means the depreciation for 2024 will be 9 by 12. Mean this will be what? 7,500. This is called charging depreciation on pro rata basis. Mean how many months you have used the asset, you should charge depreciation for those months. Obviously, first you will calculate annual depreciation. Because through straight line method formula, you will calculate annual depreciation. But for how many months you have used, you should calculate those months. If you have used for 7 months, into 7 by 12. If you have used for 3 months, into 3 by 12. So there are two methods of calculating depreciation if you have bought asset during the year, asset bought during the period. First method is pro rata depreciation. Pro rata means the number of months the asset has been used. Second method is charge full depreciation in the year of acquisition mean purchase and charge no depreciation in the year of disposal means sale. So this is based on company policy. Either they can charge full depreciation in the year of purchase and no depreciation in the year of sale. Might be in the year of sale they use the asset for 9 months, but they will charge no depreciation. The second method is that is recommended is on pro rata basis. What is pro rata basis? The months, number of months you have used the asset in the year, you should charge depreciation according to those months in the year of purchase as well as in the year of sale. Illustration 1. Where trader purchased an item of plant for 1,000 on 1st August 20x1, which depreciates on the reducing balance of 20% per annum. What is the depreciation charge for each of the first 5 years if accounting year end 31st July? If year end is 31st July, when year will start? 1st of August. And he purchased on 1st of August. This means full year depreciation. So you need to calculate depreciation for 5 years using reducing balance method. So what is cost? 1,000. So year 1 depreciation, we will calculate 1,000 into 20%. That will be 200. Reducing carrying value will be 800. For year 2, we will record depreciation 800 into 20%. That will be 160. And carrying value will be 640. For year 3, we will record depreciation as 640 into 20%. 51, no, 128 depreciation. 128 depreciation and carrying value will be 512 and year 4, this is carrying value. So year 4 depreciation will be 512 into 20%. 102? Yeah. And carrying value will be 410. 410, and for year 5, depreciation will be 410 into 20%, 82, and carrying value will be 328. This he has asked to calculate. Is that fine? This is the solution. 200, 160, 128, 102, 82. The same we have calculated. Test your understanding too. What is the total depreciation charge for the year ended 31st October 20x6? You need to calculate depreciation for 20x6 year. Kai has been running a successful nursery school, Little Lamps, since 20x1. Kai bought the following asset as the nursery expanded: a new oven for nursery kitchen at a cost of 2000 purchased on 1st December 20x4. What's the year end? 31st October.
Oh, yeah, 31st October.
So there is one asset called oven that he has purchased for 2000. A minibus, there is another asset, minibus, to take the children on trip for 18,000 purchased on 1st June 20x4. Kai depreciate oven at a 10% straight line method for this, and minibus 25% reducing balance method. A full year depreciation is charged in the year of purchase and none in the year of disposal. So for oven, is there any residual value? No. So depreciation will be cost over life. Sometime instead of life, they set a percentage.
10%.
10% mean 10 years life.
10 years.
20% mean 5 years life. So simply we will charge the calculate depreciation how? Cost into rate. What is cost? 2000 into rate how much?
10%.
10%. So 200 is depreciation for year what?
Year
20x4. We need to calculate depreciation for 20x6. So same depreciation even for 20x6, 200. Now we need to calculate depreciation for minibus for 20x6. So minibus, the cost is how much? 18,000. And year 1 depreciation mean 20x4 depreciation will be, how much is the rate? 25%. And 25% of 18,000 will be 4,500. If we deduct 4,500, the carrying value will be
13,500.
13,500. And for 20x5, we will record depreciation of 13,500 into 25%. What is that? 3,375. And carrying value will be 10,120. And for 20x6, we will 125. So 10,125 into 20%, 25%, sorry.
2,531.25.
31. Minus, we will get what? So this is the depreciation. We need to calculate only depreciation. For 20x6, for minibus is this. For oven is this. So 2731. What's the option?
Option D.
Is it fine? Now moving towards test your understanding 3. What is the total depreciation charge for the year ended 31st December 20x5 and 20x6? Can you calculate depreciation for 20x5 and 20x6 for both machines? Calculate depreciation for both machines for 20x5 and 20x6.
Method. In here, like machine two.
So machine one cost is 12,000, bought on 1st August, 20% straight line pro rata basis. Year end is 31st December. So if we talk about machine one, straight line method, 12,000 is the cost. There is no residual value and 20% is the rate. This means every year depreciation should be 2,400 every year. And for year 20x5, they bought on 1st August of 20x5. So 20x5, 2,400. Year end is 31st December. So August, September, October, November, December mean for 5 months they have used how much? 1,000. And for 20x6, its depreciation will be complete 2,400. Now moving towards machine 2. And machine 2, cost is 8,000, bought on 1st October, 10% reducing balance method pro rata. When they bought 20x6,
Yeah, 20x6.
if they bought in 20x6, there will be no depreciation for 20x5.
No.
This means for 20x5, only machine 1 depreciation will be recorded. How much? 1,000. So see 2,400 whether its depreciation is 200 or not. So machine 2, we bought cost of 8,000 and the depreciation rate is 10%. So 8,000 into 10%, it's what? 800. How many months we have used? October, November, December into 3 by 12, that will be 200. So 2,400 plus 200, that will be 26,000. Is that fine? Let's move forward. What is the accounting entry for depreciation? Depreciation expense debit, accumulated depreciation credit. Depreciation expense will be recorded in profit and loss account as expense. And this accumulated will be deducted from asset cost in a balance sheet. In balance sheet, we record asset on carrying value. How? Cost less accumulated depreciation. Illustration 2. What is the depreciation charge for the year ended 31st December August 20x5? Can you calculate? This ledger don't need to cover. Just calculate depreciation charge. Sam ran a large toy shop in Windsor. During the year ended 31st August, Sam purchased the following non-current assets. A new cash register for 5,000. This was purchased on 1st December 20x4 in time for the Christmas rush and was to be depreciated at a 10% straight line. Sam charges depreciation on monthly basis mean pro rata basis.
Good.
So 31st August is the year end. So straight line method 10% is the rate. So 5,000 into 10% will be 500 and he purchased on 1st December 20x4. This means this year 31st August 20x5 will start from where 1st September 20x4.
Yeah.
So you purchased on 1st December. This means September, October, November, 3 months gone, used for 9 months.
Yeah.
How much?
375.
So 375 is the depreciation for this. And a new delivery van purchased on 31st March 20x5 at a cost of 2200. The van is to be depreciated 15% reducing balance method. So its cost is 22,000 and the depreciation is 22,000 into what's the rate? 15%. How much is 15%? 3,300. How many months you have used? You bought on 31st March. This means April, May, June, July.
5 months.
5 months you have used. How much?
1,375.
So these two depreciation they have calculated. Moving towards next question. This is also relating to ledger. Don't need to cover this. Now this. Calculate depreciation charge for the year ended 31st December 20x3 and onward. Alfie purchased a non-current assets for 100,000 on 1st January 20x2 and started depreciating it over 5 years. Residual value was taken as 10,000. This means depreciation is equal to cost less residual value over life. So cost was 100,000, residual value was 10,000 and life was 5 years. So 90 by 5,
4,500.
4,500,
40.
4,500. Calculate once again.
Yeah.
90 by 5, 18,000. 18,000 depreciation. At 1st January 20x3,
Next year.
a review of asset life was taken and the remaining useful life of the asset was estimated at 8 years. Residual value was estimated to be nil. So for 20x2, the depreciation will be 18,000. For 20x3, we need to calculate again because now the life is 8 years and no residual value.
No residual.
So how we will calculate? Carrying value less residual value over new life. What is carrying value? How to calculate carrying value?
Yeah. Depreciation minus.
Cost less depreciation. So cost was 100,000 minus 18,000. We will calculate carrying value. Residual value is 0 divided by new life is 8 years. What's the value?
50,000.
Over 8 years.
10,250.
10,250 is the depreciation for 20x3. This is for 20x2 and this is for 20x3. Can you understand this?
Yeah.
Now I think so 10 to 50 we have calculated. Yes, 10 to 50. Now the last question and then finish. The similar question. You bought a wood burning oven for 30,000 on 1st January 20x0. Cost, purchase date. To use in a new restaurant. At that time, Yan believed that the oven useful life would be 20 years, after which it would have no value. So depreciation will be 30,000 mean cost over what's the life? 20 years will be 1,500 per year. On 1st January 20x3, after how many years?
3 years.
3 years. Mean they have depreciated 1,500 for 3 years. Yan revised the estimated previously made. The estimated life of the oven to be business was reassessed to a further 12 years. Mean it will run for 12 years. Which it could be sold for 1,500 and then there will be residual value of 1,500. So first we need to calculate the carrying value. 30,000 is the cost minus 1,500 each year. How many years we have used? 3 years.
3 years. 4,500.
So 30,000 minus 4,500 is equal to
25,000.
25,500.
Minus 1,500.
Now we need to calculate a new depreciation.
Yes.
Cost is 30, carrying value is
25,000.
carrying value is 25,500 minus residual value
1,500.
1,500 over useful life. How many years? No. Reassess to a further 12 years. In 3 already used, further 12 more it can run. Mean now the useful life is
17 plus
15 years. At first, when they bought, the useful life was 20 years. Now saying it can further run for 12 years. Further run for 12 years means 3 years already run, mean useful life is what? 15 years. But we need to take here remaining useful life, and that is 12. So what is that?
2,000.
2,000 depreciation will be charged every year. Is there option? Okay. This chapter is finished. Before coming to next class, please practice all the questions of these 2 chapters.
No class tomorrow.
No class tomorrow. Next class.